Look, you tell us I was oversold and that there were some people that were anxious to get in. I looked at it this morning. I thought it was a little bit too much of a bounce. Maybe the worst is over. I don't really know, to tell you the truth. We can close up on the highs that we saw this morning. We can close in the red. But here's what I do know. There are some stocks out there that offer compelling values. I didn't buy any of the high test stuff. I did buy some Visa over the last couple of days, added to the position. Today, I bought a biotech stock. I also bought the airlines, which I haven't been in for months and months.
So you are finding some kind of values from the sort of mass selling that we've had.
Right, and the profits that I took in partial profits, because I still own some of the positions, like Microsoft, still below where I sold it. I still think they're overvalued. I just don't believe that the last couple of days or the last week has corrected value enough, given what we know. And the bigger issue I have, I'd like Larry to address this, is that we had the president come out and attack the credibility of the Fed. That's scary if you're an investor. You know, particularly if you're not a really knowledgeable investor, you're saying, wait, the most important body in terms of monetary policy is crazy, off the rails. So to me, that's a negative, not a positive.
Let's get Liz Ann Sonders. It's good to have you, Liz Ann. It's been a while, and it's nice to see you again, especially with all that's going on this week in the markets. Give me your thoughts on where you think we are right now.
So one of the things that has not been much discussed in thinking about the timing of this correction and the speed with which it came upon us, we know the fundamental reasons. We know the pickup in the 10-year yield, which, by the way, for the first time since 1987, kind of hit its 200-month moving average. And I think that might have been a sort of a spook factor, at least those for technical analysts that look at that kind of stuff. And of course, you know, Fed getting more hawkish and some of the trade stuff the companies are talking about. But I also think sentiment started to get a little bit frothy again. I had multiple conversations in the weeks leading into the top from investors who had things to say like, I just don't see why you're pointing out the risks. There are no risks. The economy's on fire. The market's on fire. You know, nothing to see here. And it was similar to what I was seeing in December and January. Mostly anecdotal. You weren't necessarily seeing it this time in all of the sentiment indicators. It just gave me kind of a sour feeling. So I think this had as much to do with simple investor sentiment and complacency as it did with all the obvious fundamental reasons for representing a catalyst.
You feel like the correction still has more to go?
It wouldn't surprise me. It wouldn't surprise me to see us in a similar situation as we were in January and February, where you hit that kind of full 10% correction. Keep in mind, it's a midterm election year. Not that anybody doesn't know that, but the average drawdown in midterm election years in the post-World War II era is 17%. Now, that doesn't mean every year you get 17, but this would have been a pretty mild one if what we saw in January and February was the maximum drawdown. Now, the good news is you tend to see a significant bounce from those midterm election year drawdowns in the subsequent year. So I think at some point, much like was the case in February, it becomes kind of a buyable low, but I'm not a trader, so I'm not here to point to sort of days or hours.